Are you tired of chasing quick wins in the stock market, only to end up frustrated with volatile returns? Or perhaps you're wondering how to make your money work for you without constantly watching every tick of the market. If that sounds like you, stay tuned. In this video, we're diving into 3 powerhouse companies that can help you build a steady stream of passive income, no matter the market's mood. When people hear the phrase passive income, it can mean different things to different individuals. So, before diving in, let's clarify how we'll define it in this discussion. Passive income, for our purposes, refers to money earned with minimal effort. That doesn't mean it's completely effortless or without risk. Far from it. While recent hype surrounding AI-driven stocks, cryptocurrencies, and meme stocks might have made earning money look easy, seasoned investors know better. Building a reliable stream of passive income takes careful planning, sound decision-making, and a willingness to weather market volatility. Even when focusing on dividend-paying stocks as a source of income, the story isn't as simple as it seems. While dividends can generate steady income over the years, stock prices can fluctuate, sometimes significantly. Quarterly payouts may arrive in your account like clockwork, but market volatility is still a factor to contend with. That said, when chosen carefully, dividend stocks can play a crucial role in creating sustainable passive income. Ready to explore the possibilities? Let's take a closer look at 3 companies that stand out as strong candidates for passive income investors. What makes a good passive income stock? For this discussion, we focused on a few key factors. First, profitability is non-negotiable. Profitable companies are less likely to surprise investors with unexpected trouble. While dividend yield matters, the safety and reliability of that payout are even more important. We looked for companies offering at least a 3% annual dividend yield and a consistent track record of honoring and growing those payouts. Next, we considered stock price stability. The last few years have been marked by unprecedented challenges: a global pandemic, supply chain disruptions, and a turbulent 2022 in the stock market. To find stocks with below-average price volatility, we examined their 5-year beta scores. Specifically, we sought companies with betas between 0.4 and 0.8, indicating that they're less volatile than the broader market. Now, let's get into the details of 3 standout dividend stocks that align with these criteria. First on our list is Merck, ticker MRK, a pharmaceutical powerhouse. Merck is one of the world's largest and most established pharmaceutical companies, with roots dating back to 1891. Its extensive portfolio spans oncology, virology, cardiovascular treatments, and even animal health. Merck also partners with other leading research organizations, consistently pushing the boundaries of innovation in its field. Why is Merck a strong candidate for passive income? First, it's a blue-chip stock, widely recognized for its stability and reliability. Although its stock price has faced pressure recently, dropping from $135 to around $100, this decline has pushed its dividend yield to a respectable 3%. What's more, $100 has historically served as a strong support level for Merck's stock, offering potential for long-term price recovery. Merck's flagship products like the cancer treatment Keytruda have consistently driven revenue growth. Keytruda alone accounted for nearly $21 billion in revenue in recent years. Additionally, its focus on animal health, a less volatile and steadily growing segment, offers diversification within its business. This blend of innovation and stability makes Merck a solid pick for income-focused investors. Of course, there are risks to consider. For instance, ongoing discussions around healthcare reform could create headwinds for companies like Merck. However, much of this uncertainty may already be reflected in the current stock price, making it a potentially attractive entry point for investors seeking both income and stability. But before we proceed, here's a question for you. What's the most important factor you consider when choosing a dividend stock? Stability, yield, or something else? Comment your thoughts below. Now, let's move on to the next company on our list, Kimberly-Clark, ticker KMB, a household staple. Speaking of stability, let's turn our attention to Kimberly-Clark, a company that has been a cornerstone in the consumer staples sector for over a century. Headquartered in Dallas, Texas, Kimberly-Clark is organized into three primary segments: personal care, consumer tissue, and professional products. Its iconic brands, Huggies, Kotex, Kleenex, Cottonelle, and Scott, are household names around the globe. What sets Kimberly-Clark apart? As a consumer staples giant, it benefits from a moat of recession-resistant demand. Regardless of economic conditions, people will continue buying essentials like diapers and tissues. This stability makes Kimberly-Clark an attractive choice for long-term investors. Currently, the stock trades at a price-to-earnings PE ratio of 18, which isn't particularly cheap, but its consistent performance makes it a reliable passive income play. Its dividend yield is robust, and the stock has demonstrated remarkable resilience over time, currently trading at levels similar to 2016. For those focused on long-term income rather than short-term market movements, Kimberly-Clark is a solid contender. Additionally, the company's ability to adapt to consumer trends bolsters its competitive edge. For example, Kimberly-Clark has invested heavily in sustainability initiatives such as creating biodegradable and eco-friendly product lines. These efforts not only align with consumer values, but also position the company for future growth. Before we jump into the final pick, here's something to think about. If the stock market were closed for the next 5 years, which company would you trust to keep your portfolio steady? Let us know in the comments below. Now, let's explore our third pick, PepsiCo, ticker PEP. Disclaimer: more than just soda, a company that's as diverse as it is iconic. PepsiCo is a global leader in the beverage and snack food industry, with a portfolio that includes Frito-Lay, Quaker Oats, Gatorade, Mountain Dew, Ruffles, and of course, its flagship Pepsi brand. Based in Purchase, New York, PepsiCo's vast distribution network extends to e-commerce, ensuring its products reach consumers wherever they shop. Why does PepsiCo make the cut? While its dividend yield is relatively modest compared to some of its peers, it's still nearly 3 times the average yield of the S&P 500. Moreover, PepsiCo's stability and consistent dividend growth make it a favorite among income-focused investors. The company isn't resting on its laurels. PepsiCo has been investing in healthier beverage options, which could boost profit margins in the years ahead. Its acquisitions of health-focused brands like Bear Snacks and Kavita signal a strategic shift to meet changing consumer preferences. While its stock price hasn't shown dramatic growth recently, largely due to the low volatility nature of its sector, the sheer size and strength of PepsiCo's operations make it a cornerstone investment for many portfolios. The bigger picture of dividend-paying stocks like Merck, Kimberly-Clark, and PepsiCo offer a sense of security in an otherwise unpredictable market. While they may not provide the thrill of high-growth tech stocks, their resilience and consistent payouts make them an essential part of a diversified investment strategy. For many investors, these stocks represent a reliable way to generate passive income without taking on excessive risk. As you build your portfolio, it's crucial to remember that no investment is entirely risk-free. Even the most stable companies face challenges, whether from regulatory changes, shifting consumer preferences, or broader economic conditions. However, by focusing on companies with strong fundamentals, a history of dividend reliability, and stable price performance, you can tilt the odds in your favor. Looking at the table, it's clear why Merck, Kimberly-Clark, and PepsiCo stand out as top contenders for passive income portfolios. Merck offers a strong market cap and stable growth with a dividend yield of 3.2%. Kimberly-Clark combines resilience and consistent payouts at 3.7%. Backed by its recession-proof product lines. Meanwhile, PepsiCo delivers a diversified revenue stream with a solid 3.5% dividend yield and lower volatility than the broader market. Together, these companies balance profitability, stability, and reliability, key ingredients for building a robust and sustainable income strategy. Before you go, here's one last question. If you could only invest in one stock for the next decade, which one would it be? Comment below and let's start a conversation. If you found this video helpful, don't forget to like, share, and subscribe to Simple Investing Secrets for more insights on how to grow your wealth through smart investing strategies. And always keep in mind that this video is for informational purposes only. It's not financial advice. As always, do your own research and consult with a financial advisor before making any investment decisions. Thanks for watching, and we'll see you in the next video.